It is my honor to welcome our guest speaker today, Miss Angela Liu. Miss Liu has over 20 years of experience in investment, including more than a decade in venture capital. She has served as both a general partner and a limited partner in multiple venture capital firms, which has given her a comprehensive and incredibly valuable perspective on the industry from multiple sides. In this talk, she will explain what venture capital is, how it works, and why it matters. So, Miss Liu, we are really grateful for your willingness to share your time and knowledge with us. Thank you so much for joining us. And so I will exit screen sharing then, and the floor is yours. So, Miss Liu, are you able to share your screen? Hold on, I'm gonna.
Hi, Olivia. Let's see.
Yeah.
Looks like I cannot. Uh,
Oh, really?
yeah.
Okay. Did I set? Okay, I think I reset the sharing options. So
Oh,
do you think you can like try again and see? Sorry. If not, then I can share the.
oh. Looks like. Oh, maybe I can now. Yeah.
Okay.
Can you guys see my screen?
Yeah. Yeah.
Okay, great. Okay. Thank you, Olivia, for the introduction. Happy to be here. So I will spending the next 30 minutes with you to talk about venture capital, what it is, how it works, and why it matters. But don't worry, you don't need any background in business or finance to understand. I will keep simple and fun. Hope you can enjoy it. Let's get started. We all recognize these companies, Google, TikTok, Roblox. So most of us use their apps, software, or services every single day. Sometimes even without thinking about it. So what do they have in common? Actually, in the early days, they were all funded by venture capital. So the big question is, if you could invest in Google, TikTok, or Roblox, when they just started, would you do it? Yes, you would, right? Google now is a $1 trillion company, one of the largest company in the world. TikTok is not public listed yet, but its parent company, ByteDance, is one of the largest private health company globally. And Roblox is one of the most popular game platform among teenagers. But back when they just started, there were just ideas with a lot of uncertainty. Its venture capital helped turn these ideas into companies we know today. Actually, almost every successful tech company nowadays has been helped by venture capital more or less. Let's see some facts. Like 50% of US public company were venture capital backed at some point before going public since 1979. 70% plus IPO market value in many years comes from VC-backed companies. Top five largest public listing companies were all like VC funded, like Apple, Microsoft, Google, Nvidia, and which number Amazon, right? The biggest five company globally, like all like VC funded. So what is venture capital? Venture capital is actually the money investor give to small and new companies. We call these companies startups. What startups have in common? They all have like big ideas and the potential to grow fast and huge. In simple terms, the founders have great idea. They want to build something new and powerful. Venture capital give money to help them grow fast in exchange for like a piece of ownership of their companies. So if the company succeed, the VC can make lots of money. If company fail, the investor lose money. It's called a venture for a reason because venture means risk. Many startups fail and can fail, will fail. So only a few become very successful. These successful actually make up for the failures. So if people need money for their business, they usually have like two choices, or bank or venture capital. Let's see difference between VC and banks. Bank lend money is called bank loan. Bank loan had to be paid back with interest and in a certain period, like 6 months, 1 year, 5 year, 10 years. Even your business fails, you still own the bank. So bank loan require like guaranteed payback with interest. That's why bank prefers like safe, stable, profitable business. On the other hand, venture capital is very different. VC invest money in exchange for ownership, called equity. VC don't get paid back monthly. If your company succeeds, VC win big. If company fails, VC can lose everything. So low guarantee payback, no interest payment, and no term limit. You see the difference here, right? So bank make money from interest. VC makes money from like company getting more valuable. So you may wonder where VC money from. Venture capital firms don't use their own money. VC raise money from other people and institutions. VC money mainly comes from like high net worth individuals. Basically, these are like rich people. Family office, you can think of family office like a company. All billionaires have their own like family office to manage their money. Also like pension funds and university endowment funds and corporation like big corporation like Microsoft and Google. They all have their pension fund. And even nowadays, like traditional banks like have set aside some fund for like venture fund. I remember like Chipotle started a like venture capital fund like 3 years ago. It's about like $50 million. So these investors has lots of money. They are like willing to accept risk today, like hoping for big returns in the future. Let's talk about VC firm fee structure a little bit. VC firms normally charge two fees. First is a management fee. Normally it's 1 to 2% of the total money under management to pay salaries, due diligence, research, and daily operations. Second is carried interest or carry, which is typical 20% of the profit. If the investment succeeds, 80% of the gain goes back to investors, 20% goes to the VC firm. This is very like industry standard. When you hear people say like 2 plus 20, which means like 2% management fee plus 20% carry. Let's see an example here. So if a 10 million VC fund become 20 million, the profit is 10 million, right? So the VC firm keeps 2 million. The remaining 8 million plus the original like 10 million goes back to the investors. Let's talk about some of the most influential VC firms globally. Let me introduce Y Combinator first. Y Combinator or YC is one of the famous startup accelerators. It invests in very early stage companies and help launch companies like Airbnb, Stripe, Dropbox, OpenSea, Coinbase. The list can go on and on. It runs two batches each year and ends up with a big pitch event called Demo Day, where founders present ideas to investors. If a startup backed by VC, founders often gets chance to meet like more like well-known VC firms. YC is also very like college student friendly. Many founders join YC while still in school or right after graduation. If you are like student looking for VC investment, I would say YC is a very good starting point. Sequoia Capital is one of the oldest and most successful VC firms globally. It backed Apple, Google, Instagram early. A16Z is another very successful VC firm in Silicon Valley. Invests in technology, crypto, and AI. And Elon is well known for being very hands-on with founders. Excel focuses on high growth tech companies and invest early in Facebook and Slack. There are like so many VC firms specialized in different industries or different stages. These just a few of them. So what a startup anyway? It's like a brand new company try to build something like powerful, solve a problem. Usually it's like small group of people and with big idea and lots of energy, right? So startup don't start out big companies. They might start in dorm room, like Facebook, start in Harvard campus, or garage, like Google start in I think the founder's garage, or like some like random places. Most of them not like quite different from the regular business. They often like tech or high growth companies. Maybe it's an app or like B2B SaaS product or something like ChatGPT, right? Like OpenAI did. Um, Very beginning, startup not try to make the money right away. They focus on testing ideas, fix things that don't work, or expand their market. Um, People often mix up small business and startups, but they're actually quite different. A small business is built to be stable, to be profitable. Think restaurants, nail salon, children's center, or local grocery store. For example, imagine summer, you have lots of free time and you're bored. You decide to start lemonade stand in your neighborhood. You ask your mom, dad for little money to buy lemons and cups. You start selling lemonade. This is a small business. Later on, maybe you want to open a restaurant. You also can ask friends, family for money. Your business is very straightforward and easy to understand. You may be able to get a loan from a bank. This is also a small business. Startup, on the other hand, actually is very different. Is to build to scale, right? Start with big idea, often like tech knowledge related, and focus on scaling fast before profit. So the difference is simple. Like small business, like aim for profit, making money right away. But startups are different. They are aim for like scale. So unlike small business, like startups are built to grow fast, right? This means they need money before they actually make money. They need money to build product or software, hire engineer or other stuff, right? Running servers, technology, marketing the product and getting users. Early on, startups are normally not profitable, like we said previous, right? So they're spending more money than they actually earned. Think of like this, like startup are racing to become, big before someone else does. That's why they need a lot of like upfront capital to move faster, scale fast, and hopefully someday become the next big company. Venture capital usually don't invest in mature, well-known companies. We see, invest early when company is still small and valuation is relatively cheap. So at this stage, we see buy piece of the company and take on a lot of risk. If the company grows success, becomes much more valuable, the early investment can turn into something very big. That's why venture capital is all about like invest early and uh, betting on the huge return later. Let's see example here. So like company A's valuation is like 10 million. VC invest 1 million in exchange for 10% of the company, right? 1 million, 10%. So later on, the company becomes worth 100 million. So VC own 10%, 10 million, which is 10 times of the money they put in. So let's talk about funding stages. Startups don't raise all their money at once. They raise money in stages and the company, expands. It often start with pre-seed or seed funding. This is like a very early beginning. Money used to build the first product and test ideas. So next come Series A. At this stage, startup have some users or traction, and the goal is to like grow the business. Um, then there is Series B, Series C, Series D, Series E. These rounds are all about like scaling, like hire more people, expand to new market, and moving fast. Each stage comes with more money and higher company value and higher expectations. So, and startup getting big, it raises a big round from like bigger investors. That's how startups like grow step by step through these funding stages. Not all like VC firms invest at same stage. Different firms have different strategies. Some firm focus only on like very early startups, like pre-seed, seed round. For example, we see like YC, like Y Combinator. Y Combinator only invest in like very early startups. At this stage, the risk is very high, but return can be huge. Other firms invest a bit later. Sequoia Capital often invests like from early stage all the way through IPO. It's a full circle investment. But there are like other firms like focus on late stage startups. For example, the famous like SoftBank Vision Fund usually invest billions into companies that already like huge will learn. For example, like SoftBank like Vision Fund investing like billions into OpenAI. So when a startup like raising money, it matters a lot how early and how mature the company is because the different VC firm like specialize in different stages. So you can see here, like venture capital is a numbers game, right? So many companies fail, but one big success can make up for all the failures. I would say like the failure rate different from firm to firm, but in general, 7 to 9 out of every 10 startup fail. So that's why venture capital expect a loss, looking for just one maybe big winner that makes the whole portfolio successful. Let's see how VC evaluate business. VC look at the team first. The founder has to be smart, motivated, and learn quickly. We often say like we invest in people first because there might be like 100 companies building the same product at the same time, right? What really matters is whether this team is the best one to build it. And for me personally, if the tech company, I expect the founder to have a technical background because when an app or a software crash in the middle of the night, the founder, I expect the founder should be able to like jump in and fix the problem quickly. Not waiting until the next day when all the developers come back. Next will be the market. The market size had to be huge. If the product or service only built for a small niche market, the company won't be able to scale. This you're not a good candidate for venture capital then. The next one will be traction, which is the proof that company find product market fit. Something like how many users use this product. Do user like it and keep coming back? Is there like early revenue? This is like pretty much the framework how we see like evaluate startup. Okay, this is my favorite part, liquidity event. After years of hard work, both VC and startups finally get the big payday. This is the like the startup and the VC turn the company into real money. One big outcome is through IPO. That's often, every startup founder's goal because when company goes public, it can worth like billions of dollars, not just millions. That's why like IPO is like powerful goal for like every founder and VC. Another path is the acquisition. This is when a big company buys smaller companies. For example, last year, I think just right before Christmas, large tech company NVIDIA just acquired, a chip design startup company Grok for like 20 billion. Our third option is buyout, which means like a private equity firm, take over or control the whole company. Let's see a real VC investment story here, Instagram. Instagram considered is a very like classic VC success story. Let's see why. Instagram started in 2010, was just a tiny app, had two founders, no revenue for sure. Honestly, just a simple idea, make it easy and fast to share photos. At that time, the no guarantee they will work because like photo sharing app, there are like tons of competitors in the market. But this is exactly the kind of thing like venture capital, looking for, right? A small team, a great idea, and not a uncertainty, but big potential. So early VC firm invest 500,000 seed funding, exchange for like small ownership stack. The money helped Instagram hit 1 million users just under 2 months, 30 million users under 2 years, became one of the fastest growing apps in history. All this happened before Instagram make real money. Here comes the big payday in 2012. Like Facebook bought Instagram for 1 billion. At that time, Instagram still small, only has 13 employees. Still experience huge user engagement, generate under like 1 million revenue. Even though the company is still small, the user base and engagement were huge. That's what made the Instagram incredible valuable. Why is this basic success? This is actually really a win-win situation. It's a big win for VC investors, right? Because they invest early, the return was huge. There was also a big win for Instagram team, the founders, the early employees, and everyone who helped build the product. And also it's a win for Facebook as well, right? Facebook now, or Meta is now like $1 trillion company. Based on that scale, Instagram alone is likely worth, I think, over maybe like 100 billion dollars. So everyone wins. And we see the founders, the team, and the company, Facebook, who actually acquired Instagram. This is what great like venture capital outcome looks like. So that's why it's considered very like classic VC success. So what a student can learn from this example, I would say like be curious, having problem solving mindset. That's very important, right? Because all the idea pretty much come from daily life. And be a team player. That's all. Uh, you know, this is the final message today. So this is all about like believing in future. Maybe one day you start your own startup. VC will invest in you. Thank you. Any questions?
Okay, so let's give a big round of applause to Mrs. Liu. Thank you so much, Miss Liu, for that fantastic talk. It was very clear and like very in-depth. I think we all learned like so much about like the
Thank you.
structure, workings, details. So, yeah. So thank you so much. So does anyone have any questions then?
I have a question.
Oh, okay.
I'm referencing the when you talked about Instagram and its growth. I was wondering why it didn't make any real money, even though it had all the publicity it had at the start.
Oh, is it because they're burning more money to acquire users and maybe like marketing lots of money to make the product well known and even though it's a small team, they spend a lot of money on marketing acquire users. When the company in early stage. I would say marketing is a huge expenses. Also like development, they have like because there's so many users have to make sure the sites all up all time 24/7. That's this not of like computing power, that's very important. I don't think they actually have their own like data center. They actually rent all the, data center stuff. So that's quite a amount of money too. So pretty much the revenue is really not a lot. But because Instagram is basically it's a free app, and until recently they started making money by putting all the ads in the Instagram. But early on they don't have it's ad free app, so that's why they don't have any revenue at that time.
Oh, okay. Thank you so much.
Mm-hmm. No problem. Okay, then.
I have
If
a question.
oh
Um,
sure.
Miss Liu, thank you for your fantastic talk.
Okay.
I wonder when you are doing investment and
Mhm.
what are your criteria for looking for a good candidate for you to invest?
Oh, for our company, our firm, we actually during the past 10 years, we mainly focus on like software.
Mm-hmm.
Most of our investment, we choose actually B2B SaaS product. So basically, it's like, it's 2B software. That has been proved that can work in past 10 years. So yeah, so we focus on that market. So that vertical market. So we focus on B2B SaaS, business to business software. That's why we specialize in. And we normally we invest along with not large firms like Sequoia and A16. They even in Texas, like we investing with Capital Factory, the one of the largest research firm in Texas, based in Austin. So for criteria, like I said, we normally because we focus on early stage, so we normally very like we're not doing like seed round or like the pre-seed funding. So unlike YC, we normally invest in like Series A or Series B when company like can prove they actually can the product can work and has some users. So like but still very early stage. For us, like the team, probably the most important thing because we have to make sure the team, know what they're doing, know the business model and know how to spend the money and can execute the plan. That's very important. We normally like spend like 3 months work with the founders and do due diligence and maybe spend some like 1 month to research the market. So we have to make sure the market size is big enough to accommodate so many companies because one great idea the for sure they're like not just one like many company doing the same thing at the same time. So we want to make sure this company can succeed. Yeah, so team first, then it's the market. Then I have to say that execute like executive team is very also very important because later on the founders step down. They will hire like professional like CEOs or CTOs to manage the company. We have to make sure the executive team is also like can execute the plan, the business model. Yeah, that's all.
Yeah, great insights. Thank you.
Mm-hmm.
Yeah, great. So I think Arav, did you have a question? Oh, okay. So also I have a question though. So like Ms. Leo, you said before that venture capital firms like help connect like startup founders to like other people can like connect
Right.
them. So can you like explain more about how that works? Because I feel like that's like really interesting. Like not only do they like help like startup founders like with capital, they also like help with connections. So
Oh, right. Yeah, because founders more than more they need just more than money, right? So they need money for sure. But nowadays they also looking for connections, like they need a mentor. So if like, young founder, most people start founders, they are like first time founders. So yeah, first time, they need experience. So we have to like, introduce like more senior, maybe people like succeed before or some like big companies like so the founders can also get like skills from those senior people. Like not just the ideas, but like execute the business plan, also like manage the company. They also needs lots of advice. So we sometimes we even like form like a advisor group for them. That's how we like connect founders with people. Sometimes we help the like people if this so we think this company not our candidate, we also pass this company to other firms. So that's also very important because maybe other firm can see something we cannot see. So that's why we normally when we not when they're not candidate for us, we also introduce them to other visit firms.
Wow, thank you. That's so cool. Because
Yeah.
as like I was thinking like if any of us are interested in entrepreneurship, I personally am. So I was like, wow, that's like really interesting about like how venture capital can help you. So yeah. So I think Sebastian, do you have a question for Miss Leo?
Do you have any thoughts on why the companies like SpaceX, Anthropic, and OpenAI have been IPO when they're so big?
Right, because the funding they have mainly round of funding. They probably each round of funding the company gets more money and gets bigger, right, through the funding stage like we talk about. So each round it gets more money because those companies they are like huge. They're doing like billion-dollar business. They have the company size first is very huge, right? They have lots of people. Also, they need a lot of resource. Like SpaceX size is like huge, like rocket science company. So definitely it's not a resource. No matter physical or software, whatever they need. That I think right now, and also like human capital is very expensive too, right? Like people hire engineers that are quite expensive. They pay high salaries to compete with, those like already like well-known companies like Google. They have to hire engineers from other big companies. They pay more so people can, join the startups. So, they spend more money. And then I don't think that actually none of them actually, I should make money right now. So that's why once through IPO, actually they can, at least, return some money to investors, to early investors through IPO. I heard like this year like space, probably the biggest IPO in history is like more than $1 trillion valuation. But they can, get like I think they're going to get like 500. No, no, not 500. Yeah, $50 billion from the stock market to pay back the early investors and maybe some of the employees. Yeah. And Asorapi also too, the company is already huge. Then the all the VC and the team wants the big payday, right? That's it's totally it's understandable when market is good. I think this year is a pretty good timing for them to go public to go to IPO. Mm.
Thanks.
You're welcome.
Okay, so I think Emily and Vihan also raised their hands. So Miss Leo, if you want to answer their questions, that's
Sure.
good too. Yeah. Yeah. Thank you so much.
I was wondering, thank you so much for your talk, by the way, but what experience or skill set would you recommend for someone trying to get into venture capital?
Oh, actually, VC firms hire people like from all kinds of background. The founders maybe when the succeed, finish one company, the become like because they believe in venture capital, so they can join venture capital for sure. And some of new graduates, our firm also hired new graduates. Before, those people from all kinds of backgrounds. We're not limited. limit to a certain, major or something. We don't. So, but we certainly, normally do campus hiring from through like some like, elite universities. That's kind of sad, but that's the truth. But that's the reality. So you have to get into, those elite university to get a chance to work for VC as associate or assistant something at very entry level. So that's another way. And also if you have some like consulting background or like business background, that's also helpful. That's very helpful. Yeah, people, you just have or MBA. Yeah, we last I think like 5 years ago we hired a staff for MBA. Yeah, yeah, that's to be the associate like yeah.
Yeah,
But
wow, I've actually heard of that too. When like I've read like some books and like they say like for a lot of business like professions like venture capital or like consulting, like it's very important to have like a good college degree like MBA, like some kind of
right.
prestigious college. Yeah.
Right, yeah, yeah. You have to, I would say like you have to be like smart and motivated. Like all the founders hardworking, that's required, you know. Yeah, it's basically like for all industry. I think that's all required. Yeah, be a team player because you have to go talk to lots of people. You have to, go to those pitch event to meet 100 people. Everything in not just in one day. Yeah. So the people skill is very, very interesting, very, 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 very helpful. Yeah.
May I ask my question?
Sure.
No. Is Shark Tank a co is Shark Tank a venture capital?
Oh, Shark Tank is sort of venture capital. I always say it's like very similar. But I think Shark Tank because the TV show, right? It's used the venture capital form to do the TV show. Actually, it's I would say it's a venture capital because once you succeed, you get money from all the investors, right? Yeah, from Cuban or other investors. Yeah, it is. But it's more like they like because something have to be presentable on TV. Those things more like have to like physical stuff cannot be something like software you cannot see on TV. So it's most like a focus on like more on the traditional side of the VC, not the very technical side of VC. I would say it is. Yeah. That's a good question.
Hi, Miss Leo.
Yes.
Thank you so much for talking to us today. I remember that you talked about the different rounds of VC. Could you like elaborate a little more on that?
Oh, yes. When people, first have this idea, they don't have any resources, right? So they need money. They don't want to put the, the whole, all the money, their own money into the company because the company already risky, right? So they want to use other people's money. That's basic idea. So when that's this great idea, they try to find something to fund the company. So then take the company off the ground. So that's called like seed funding. So they pretty much looking for like early investment, early venture capital firms like Y Combinator. They go present ideas. Let's see, can YC can give them some money, 100K or 200K or something, 500,000 at most. To take the business off the ground. Once they form the company and have built the first product, they probably need more money, probably not just the founders, they need probably like more people, like, engineers or like salespeople, not even, maybe not marketing, maybe sales, maybe one person or something, to sell the product or, to engineers to like help like build the product. And so that's why this is called like Series A. And Series A also can, they have this money to help them to getting the user, maybe getting the first 10 user. So that's Series A. Then later on, once they prove the market accept their product, So they want to scale fast and then expand to like new market or something. So that's come with Series B or Series C, Series D. Those later ones are all about like scaling, making the company big, hire more people and you expand to new market, getting more users. That's how make the company, even more valuable. That's how like startups like go through this funding stages.
Okay, thank you.
Okay, great.
I have another question if you can.
Okay.
I was wondering when businesses fail, when they get funding but they fail, do they have to pay it back? And what if they can't pay it back if that's the case?
Oh no, you don't because it's venture capital, right? The venture capital firms understand this, expect loss. So VC you don't have to pay back VC money. There's no guarantee. It sounds like the bank loan. You no guarantee payback. So loss is a loss. So we all like accept this, because AV the failure rate is pretty high. Like 7 to 9 out of 10 will fail and can fail. So really failure rate is really high. When you see those big companies, actually they are like probably one in every like the 800 companies. Like each year, like when I go to the YC event, like I think like 200 for maybe 200 300 in each batch. I would say like maybe like five of them can succeed. Most will fail. So yeah, venture capital expect loss. You don't have to pay back for the money they say, investing in.
All right, thank you so much.
Okay, great. Thank you so much, Miss Liu, for like answering all our questions. And that was like a really amazing talk. So thank you. I appreciate like your time and like you spending your time and energy to like help us learn.